Hello friends, how are you? So in this video we are going to see the interview questions and journal entries. Before videos we have see the introduction, and today we will see the interview questions and their answers. So these are the questions which is asked in our Accenture, EY, Accenture, TCS, KPMG, Deloitte, and in many MNC companies. Okay, so let's start the video. So first question is, what are the three golden rule of accounting? So we know the three golden rule of accounting. There are three account: personal account, real account, and nominal account. So according to the golden rule of accounting, debit the receiver, credit the giver for the personal account, and the real account, what comes in debit, what goes out credit. In nominal account, all expenses and loss debit and all income and gains credit. Okay, move to the next question. So we have given the examples, we have given the definitions, we have given the numerical problem also related to the questions. So everything we will not discuss here. We will discuss the detail in the maybe in another video. So today only we will see the uh, questions. Only we will see the questions and their answers. So golden rule of accounting, we know. And if you want, you can pause the video and uh, you can copy the theory part of the video and the explanation of the video. What is real account? What is personal account? What is nominal account? It is given. Examples, we have given examples. Suppose purchase furniture for 10,000 in cash. So the furniture account will be debit. Furniture is a real account, and according to the real account, golden rule is what comes in business debit, and cash account credit 10,000. Cash is a real account, and what goes out from business is credit. So cash is going out, furniture is coming in. Next is paid 15,000 cash to Unreal Private Limited. So the journal entry will be Unreal Private Limited account debit, cash account credit 15,000. So here Unreal Private Limited is receiving the money and cash is going out from the business. So Unreal Private Limited is a personal account, and according the rule, debit the receiver, and cash, we apply the golden rule to the cash. So cash is a real account and cash is going out from the business. I hope it is clear to you. So in every transaction we cannot do this because the video will go long. As much as possible we explain and do it. Paid 18,000 from bank for rent. So here what is the journal entry? Paid 18,000 from bank for rent. Rent account debit to bank. Account involved, two account is there. Two account is there. One is rent, another is bank. So rent is a expenses. So it is a nominal account. So rent account debit 18,000, and bank is a personal account, as well as I think there is a mistake. Bank is a real account. Bank is a real account. So and bank is a company also. So bank is a real account. So cash is bank is going out from the business. So it is a credit. Okay, next entry is depreciation charge 1 lakh rupees on straight line method. Depreciation account debit to machinery. Depreciation is an expense. Nominal account, all the expense debit. Machine is a real account. What goes out from the business is credit. Sold goods for 5,000 on credit to Mr. Unreal. So the account involved is Mr. Unreal account. Journal entry is Mr. Unreal account to debit. Sales account to credit 5,000. So Mr. Personal Unreal is a personal account and personal account to debit the receiver, credit the giver, and sale is a income. It is a nominal account. So nominal account income is credit and expense is debit. Second questions. What are three main types of accounts? So the three main types of account is real account, personal account, and nominal account. Real account. All the assets in business, either tangible or intangible, classified as real account. And personal account related to the person, entity, legal body, etc. are called personal account. What is nominal account? All the account related to the expenses and loss, income or gain is called the nominal account. Why is depreciation not charged on land? This is another very important question. The reason why you will never see depreciation being charged on the land is that land has been indefinite useful life. Suppose what is the formula to calculate the depreciation? Cost of assets minus scrap value divided by life of the assets. So we know the land has no life, means we cannot tell this land is there for 5 years or 10 years or 20 years uh, because land is infinite, it will be eternal. Sometimes the value may be increase or decrease because of depends on the future outcomes. Maybe in some places volcanoes goes and some places attacks happens. So the value can be increase or decrease, but it will be eternal for the lifetime. So because of that we are not charging the depreciation. The formula to calculate the depreciation is cost of fixed assets minus scrap value and divided by useful life. So next question is what is amortization? So amortization depreciation is charged on the tangible assets and amortization is charged on the intangible assets. Amortization is only done for intangible assets, unlike the depreciation, which for tangible assets. So, what is amortization? Amortization is the reduction in the value by prorating the cost of intangible assets over multiple accounting period is called amortization. The reduction in the value, the reduction in the value by prorating the cost of an intangible asset over the accounting is called the amortization. So we have given the example. Suppose one small business technology Unreal corporation spend 5 lakh rupees on the R&D, which is expected to sustain for 5 years. So it decide to amortize these expenses and so 1 lakh rupees each year for 5 years in the financial statement. So here company is investing some amount on their research and development, and but this expenses is for the longer period. So therefore it is an investment which which will give the benefit in the multiple accounting year. Why closing stock is not shown in the trial balance? So closing stock includes your closing stock includes your opening stock plus purchase, and whatever the stock item remains that becomes your closing stock. So the count of the stock is already included or depends on the purchase plus opening stock. So it is already included. That's why it will separately shown from the out of the trial balance, because in trading account it will be already counted. So we can see not all the goods purchased in beginning and during the accounting period are sold until end of the period. This result this result a reminder balance known as closing stock. Closing stock is a part of purchase. Already I told closing stock is a part of purchase, and trial balance already include the purchase. If the closing stock is shown as a separate item, it will count, it will double count. It will not only count, it will double count and result in an error. For example, purchase for the period is 60,000, closing stock, that means remaining stock of purchase 10,000. If both of these items are separately shown inside trial balance, the effect will double up and the trial balance will error out. So because of that, this is also among the top financial interview questions. Okay, next. What are the three main financial statement? So the three main financial statement is income statement, balance sheet, cash flow statement. What is the income statement? Income statement summarize the view of revenue, income, profit and loss of particular accounting period. Balance sheet shows as on date assets and liabilities, capital position of the business, and the cash flow statement shows the movement of cash and cash equivalent for the business during the accounting period. Okay, so next question. What is capital? What type of capital account and where it is shown in the financial statement? So what is the capital? Capital is also called the owner's equity. Capital is the money brought into the business by the owner of the business, brought into the business brought into the business by the owner of the business as an investment to start the operation. Capital is a personal account as it belongs to an individual or firm or owner. Okay, so next question. Capital is shown as a liability side of the what type of account? The second question was what type of account? So I will just take capital is a personal account. Capital is a personal account. This is the second part of the question. Capital is a personal account where it is shown in the trial balance. Sorry, statement, financial statement. Sorry. Capital is shown liability side of the balance sheet. So we will see the next question. What are fictitious assets? Fictitious assets are not assets. They are the fake assets or deceptive assets. They are actually the expenses and loss. They are actually expenses and loss for which could not be written off during the accounting period incurred. They are written off in multiple future accounting period. For example, of fictitious assets are preliminary expenses that incurred during the incorporation of the business, promotional expenses of the business like advertising, discount allowed on issue of share, and loss incurred on issue of share. Fictitious assets are shown in the balance sheet on the asset side. Next question is what is journal entry for goods given in charity? So we know goods given in charity. Charity is like an expense for the business. So the expense account debit to purchase account. Why we are crediting the purchase account? Because we are giving the goods as a charity. We are not giving the money as a charity. So that's why we are crediting the purchase accounts. If we give the cash in charity, so our cash account will be credited. So next question is what is the entry for free sample? Free sample. Why the free sample we give to promote the business? So we are doing the advertisement. We are doing the add-ons. So the journal entry will be purchase account debit. Sorry, advertisement account debit to purchase account credit. Next question is what is depreciation? Different type of depreciation and its journal entry. So depreciation is the reduction in the value of the tangible assets due to its wear and tear or new technology or unfavorable market condition is called the depreciation. There are six types of depreciation, mainly six types of depreciation. So the first is straight line method, diminishing value method, annuity method, machine hour rate method, revaluation method, sum of year digit method. And what is the journal entry for the depreciation. So the journal entry for the depreciation is depreciation account debit, depreciation account debit to assets account. So the depreciation, we are assuming that we are not maintaining the depreciation on, we are not maintaining here the accumulated depreciation. Otherwise, if you are maintaining the accumulated depreciation account, so your journal entry will be depreciation account debit to accumulated depreciation. Accumulated depreciation. So we will go to the next question. What are contingent liability? Contingent liabilities are those liabilities that may or may not be incurred by the business depending on outcome of future event. The existence of this kind of liability is completely dependent on the occurrence of the probable event in future. For example, let's suppose Apple files a case of a patent violation or copyright violation on Samsung, and Samsung not realize that it may have to pay for the violation, but also estimate how much in total. In this case, Samsung will record the estimated amount in their book of account as a contingent liability. Sometimes, so we what we understand, this is based on the future event. Any dispute happens on copyright or any legal agreement or any other terms and condition which violate in the futures. So this is the that kind of the liability. Next is what is the difference between the reserve and surplus? What is the difference between reserve and surplus? Why this button? What is the difference? So reserve, there are many differences, but few are here given. A reserve are made to strengthen financial position of the business, and provision are made to meet the specific liability in the business. Reserve are made when the business is profitable, but the provision are made even business is in loss. Reserve can be used to distribute the dividend to the shareholder, but the provision amount cannot uh, distribute as a dividend. Okay, and next is dividend is debited to the profit and loss appropriation account, and your provision is debited in the debited. Your provision is shown in the profit and loss account. Basically, it mean to say provision is shown in the profit and loss appropriation account, and dividend and provision is shown in the profit and loss account. Dividend is not mandatory. Sorry, provision is not provision is reserves is not mandatory to create, but the provision is mandatory to create in the business. Reserves are shown on the liability side of the balance sheet, but provisions can be shown in the asset side by deducting the amount from the respective account. So next question is, what are accruals? Another very important questions. So accrual are expenses and revenue that have been incurred or earned but not been recorded in the books of account. So adjustment entries are incorporated in the financial statement to report these at the end of accounting period. There is two accruals, accrued expenses and accrued income. What is accrued expenses? Accrued expenses is an expenses which have been incurred but has not been recorded in the books of account presently. It will require an adjustment entry in the books of account to reflect this in the financial statement. Opposite of that in accrued income. Accrued income is an income which has been earned but not recorded in the book of account presently. Similar to accrued expenses, adjustment entry required to pass to show the entry in the books of account. Okay, what is contra assets? What is contra assets? Contra assets is an account which is used to reduce the value of the associated account, related account, integrated account. It is an account which is used to reduce the value of the associated account. It holds the opposite sign for the particular type of account. Okay, if an account has a debit balance, for example, in assets, then there will be a credit balance in its contra account. The opposite is true for a liability account. The opposite is true for the liability accounts. For example, of contra account, your fixed assets account, and opposite to the fixed assets account, accumulated depreciation. So accumulated depreciation account, whatever the depreciation we charged against the assets, all all the period depreciation amount we will put in the accumulated account. So when we replace the assets, we have already calculated the total of the depreciation. Okay. In detail, if you want explanation, we will we will make a separate videos. Next question is, what are drawings? What type of account it is and journal entry drawings? When a proprietor withdraw cash or goods from its own business, when a proprietor withdraw cash or goods from its own business for personal use, it is termed as drawings. Drawings reduce the capital invested in the company and is a temporary account which is cleared at the end of each accounting period. So it is a personal account. Drawing is a personal account. What is the journal entry for it? Drawing account debit to cash. Here I will tell one more thing. If the owner is taking the goods from the business for personal use, then instead of cash account credit, you have to credit your purchase account, because if the goods is going on means your purchase account will reduce. So your journal entry will be per drawing account debit to purchase account. If it is taking the cash, then drawing account debit to cash account. Okay, next entry. What is bank reconciliation statement and why it is prepared? Almost all the companies prepare the bank reconciliation. They do the bank reconciliation. Bank reconciliation statement refers to the statement which is made to reconcile the bank balances and balances on your bank bank ledger in the company's book. So sorry, your bank statement is refers to the external source. Bank statement, external source to reconcile the bank balance shown in the bank statement and bank statement or passbook balance shown in the cash book and bank ledger, bank balance shown in the cash book. It is internal document. It is a comparison between your bank statement and internal and external. Both internal resource, example cash book, and external source, example bank statement, reconcile with each other, then all the mismatch are identified properly. Okay. Reason for preparing the bank reconciliation statement, mistake and error. So if we did not do the reconciliation monthly, periodically, there might be chance of errors and mistakes. Bank reconciliation statement helps to detect the errors and mistakes in cash flow and explains delay. So if you do not prepare your bank reconciliation, there may be delay of your payments or receipts credited to your accounts. Any delay in clearance and collection of checks can be identified if you are doing it regularly. Fraud detection. Another important is fraud detection. Timely reconciliations helps to prevent and found any fraud to the cash accounts. So mainly these things like delay, errors and fraud are the main reason for preparing the bank statement. Next question is what is deferred revenue expenditure? What is deferred revenue expenditure? So the deferred revenue expenditure, it is an expenditure which is in revenue in nature and incurred during the accounting period, but its benefit to be derived from number of following accounting period. Following means future accounting period. It is an expenses which is revenue in nature and incurred during an accounting period, but its benefit are to be derived from number of following accounting period, number of future accounting period. The part of the amount which is charged to the profit and loss account in the current accounting period is reduced from the total expenditure and the rest amount shown on the balance sheet as an assets. The rest amount current accounting period reduced. Rest amount, rest area MOUNT amount. Example, a business spends 1,50,000 on advertising, which is usually large for them. The benefit from it are expected to be derived over 3 years. So the company decide to divide the expenses over 3 years. Yearly payment of 3 years. Yearly payment of 50K. This type of expense is called the deferred revenue expenditure. Okay. So each year 50,000 they will charge. What is the difference between the trade discount and cash discount? What is the difference between the trade discount and cash discount? So the first difference is trade discount. Trade discount provided by the supplier of goods and service on the list price, and cash discount is allowed by the supplier of goods and service to the buyer from the invoice price. So basically want to say your payable amount, cash discount is given on payable amount and the trade discount is given on your MRP amount. Trade discount is provided due to the business considerations such as trade practice, large quantity, order, etc. So why we are giving generally the trade discount? To sell in the bulk, to grow the business. And why we are giving the cash discount? It is provided as an incentive or motivation in return for paying a bill within a specified time. To make payment early, we are giving the cash discount. Next difference is trade discount is not separately shown in the books of account. This is the main differences. Trade discount is not separately shown in the books of account, but cash discount is separately shown in the books of account, and it is charged against the profit and loss account. Fourth difference is discount is allowed on both credit and cash transactions. Trade discount is allowed or given on both cash and credit transaction, but cash discount is only allowed on the cash payment. If the customer payment is due, on then only we can allow the cash payment, cash discount on cash uh, payment. Okay, last difference is trade discount is given on the basis of purchase and cash discount is given on the basis of payment. That was the main difference. Okay, so next question is what is a credit note and debit note? What is a credit and debit note? Debit note when a buyer returns the goods to seller. That is when buyer returns the goods to the seller. Debit note is also the purchase return. Purchase return. It sent a debit note as an estimation to seller of seller of the goods, seller of the amount and quantity being returned and requesting the return of money. Next, credit note is nothing but the sales return. When a seller receives the goods returned from the buyer, it is called the credit note. When seller receives the goods returned from buyer, it is called the sales return. Here, company received the goods from the customer. It represent and send a credit note as an estimation to the buyer that the buyer showing that the money for the related goods is being returned in the form of credit note. Next question is, what is the journal entry for accrued income? So, what is the journal entry for accrued income? So, we know the income income is always credit. So the accrued, wherever the word accrued will come, you have to just make the opposite of the normal balance. So normal balance, what is the normal balance for the income? Normal balance of the income is credit. So whenever the word accrued income, you have to make opposite of the normal balance. So your accrued income will be opposite of the normal balance. So the journal entry will be accrued income account debit to income account. When we earned the money but not received, so we will make the journal entry accrued income account debit, increase in assets, to income account credit, increase in income. So we have given examples also. So when we earn but not receive, so when we earn, what will be the entry? We will reverse the entry. We will credit the accrued income and we will debit the bank account debit to accrued income account credit when we receive the money. So here is the explanation and here is the questions also. You can go to the questions. So video will go long. So we are skipping the questions. You can go through the questions also. Journal entry for received in advance. ADVANCE advance. What is wrong here? Advance is also known as unearned. It is income which is received in advance. However, the related benefit are not provided to the customer. It belongs to a future accounting period and is still to be earned. Journal entry for the income received in advance recognize the accounting rule of credit in the increase of liability. So what will be the journal entry? When we receive bank account debit to income received in advance account credit, which if it is not earned, when we receive the money in advance, what we will do? Bank account debit. Generally, the entry will be income account debit to income received in advance account. But when we receive the money in advance, we will debit bank account and credit income received in advance account. So when we genuinely earn that money, when we provide the goods and service, so we have already received the money. So again we will not receive the money. So we have already created the advance account, money received in advance. So we will debit that account. Money income received in advance account debit to income account. Income received in advance account debit to income account. So here is the example. You can pause the video, take the screenshot, and you can practice on the journal entry. So this is the entry for the receipt of advance, cash or bank account debit to rent received in advance account credit. So rent received in advance account, rent received in advance account debit to rent received in advance account debit to rent received account. Here is one extra entry is shown. you can skip that entry. Okay, this which question is this? Financial statement and treatment. Okay, rent received in advance account debit to rent account. Shown in assets balance sheet under the current assets. I am unable to find out question type. Okay, no issue. This is the example for accrued commission. So accrued commission account, accrued commission account debit to commission account credit. Journal entry for interest, accrued interest account. What are outstanding expenses? What are outstanding expenses? So this entry commission received is there in advance, income account credit to income received in advance account. So income account debit to income received in advance account. So we have already seen the entry. Simplifying with the example. So here basically you can make two entries or you can make the three entries. So here first we have received the money, bank or cash account debit to bank or cash account debit to rent received. So the next entry will be rent receive account debit, rent account debit to rent receive account debit to rent receive in advance account credit 1,20,000, and final entry is rent receive in advance account rent receive in advance account debit to rent account. So this will reduce the balance for 1 month. So similarly example, next questions we will go example for accrued commission, that is commission earned but not received. So the commission earned account debit to commission earned account debit to commission account will be the journal entry. Similar journal entry for accrued interest account debit to interest received account. Next question is our outstanding expenses. Outstanding expenses are those expenses which have been incurred during the current accounting period and are due to be paid. However, the payment is not made. Such an item is to be treated as a payable for the business. Example, outstanding salary, outstanding rent, outstanding subscription, outstanding wages, etc. Outstanding expenses are recorded in the book of finance at the end of the accounting period to show the true true numbers of the business, true numbers of the business or true numbers or true figure of the business. So we will see one examples here. Journal entry for outstanding expenses. Expenses account debit to outstanding expenses. If outstanding expenses already appear inside the trial balance, then it implies that the adjusting entries had already been posted. In this case, it is only shown in the balance sheet as a current liability and no adjustment is required in the income statement. Journal entry for depreciation. Depreciation reduction in the value of tangible assets due to the normal use, wear and tear, new technologies, unfavorable market condition is called depreciation. Journal entry for the depreciation depends on the whether the provision for the depreciation or accumulated depreciation account is maintained or no. Such such as plant and machinery, building vehicles, furniture, etc., which are expected to last more than 1 year, but not for an infinite number of years are subject to depreciation. Below journal entry for the depreciation assume that depreciation is charged directly to the assets. Depreciation account debit to fixed assets, assuming no provision or accumulated depreciation account is maintained. Golden rule of accounting applies in the above journal entry. Depreciation, nominal expenses, debit all expenses and loss. Assets, real account, debit what comes in. So then the depreciation is transferred to the profit and loss account. So we know when we charge the expenses, our profit will our profit will go down. If we get income, profit will increase. If we charge, profit will decrease. So the profit and loss account debit to depreciation account. Why depreciation is not charging land? We have already discussed on it. No useful life or infinite life. IO formula can't be fulfilled. This is the reason why the depreciation is not charging. This is the depreciation. This is the reason why the depreciation is not charged. What is the journal entry for discount allowed? So we know where we can allow the discount. We will allow the discount at the time of sale. We will allow the depreciation at the time of sale, and discount is given to uh, get the customers. Discount as in exist discount allowed at additional expenses for the business, and it is shown on the debit side of the profit and loss account. Trade discount is not shown in the main financial statement. However, the cash discount and other type of discount are supposed to be recorded in the books of account. In case of transactions where both the discounts and cash discounts are allowed, the trade discount is allowed first and then the cash discount is processed. Okay, next question is journal entry for discount allowed. So what is the journal entry? Cash account debit or bank account debit to discount allowed. discount allowed account debit to debtors account or account receivable account when we make a sale. Cash or bank account debit, discount allowed account debit to debtors account. Cash is a real account, what comes in debit. Discount allowed is a nominal account, all expenses debit. Debtors account is a personal account, credit the giver. Discount allowed increase the expenses for seller. On the other hand, it reduced the actual amount to be received from the sales. Transaction accountant rule. Business allow the discount account, cash account involved, discount and account involved, and debtors account comes into the picture. Rule: debit the debit the increase in assets, debit the increase in expenses, credit decrease in assets. Journal entry for discount allowed. This is another example. Suppose we are selling the goods for 50,000 and giving the 10% discount. So the journal entry cash account debit 45,000, discount allowed debit 5,000, and unreal account 50,000. Next is same questions. What is the journal entry for discount received? So discount is received. We get at the time of sale. Discount allowed we do at the time of sale, and discount receive we will do at the time of purchase. Discount receive. What is the discount receive? So discount receive when we are purchasing the goods and the seller is giving us the discount. That is called the discount allowed, discount receive. Journal entry. We will see the journal entry. You can pause the video and you can ask the and you can watch the description and the detailed explanation. So, what will be the journal entry? Creditor account debit to cash account credit to discount receive account credit. This is the journal entry, and this is the rule for the journal entry, and this is the example of the journal entry. Payment made to unreal company 5,000 rupees at 10% discount. Discount receiving the regular course of the business. So unreal account, we will debit the account of unreal because we are making the full payment to unreal 5,000. We are not making full payment, but we are supposing we are making the full payment. So unreal account to debit 5,000 to cash account. Cash is going 4,500 to discount account credit 500 rupees. Second example. This is the second example. First example, second example. Next is the journal entry for prepaid expenses. Prepaid expenses are those expenses which are paid in advance for benefit yet to be received. The bulk of such expenses are yet to be utilized in the future period. Below is the journal entry for the prepaid expenses. So the journal entry for the prepaid expenses is prepaid expenses account debit to expenses account. Prepaid expenses account debit to expenses account. And explanation, you can see the explanation. Simplifying with the example, you can see the examples. On December 2019, company pays 1,20,000 10 into 12 month as rent in cash for next year for the period January 20 to December 20. Show all the entry including the journal entry for prepaid expenses on these dates. So 20 on 28th we have same day, and December 31st 2019 end of the period, and 1st January on December 1st January January 1st 20 to December 1st 20, beginning of each month next year. So the journal entry on 20 December. Rent, he is paying is a rent. So the normal entry is a rent account debit to cash account. A rent account debit to cash account. December 31st December we will book the expenses. 31st December we will book the first month expenses. Rent account. So we can skip here we can skip this entry as what we are doing here. Company pays, we can make when at the time of payment advance rent account debit to bank account or cash account. Advance rent account debit to prepaid rent account. Prepaid rent account debit to bank account or prepaid rent account debit to bank account or prepaid rent account debit credit bank account. And at the at the end of the month we will book the expenses of 1 month. So rent account debit to prepaid rent account. Rent account debit to prepaid rent account. Because we have already credited the bank, so again we will not credit the bank, and from the next period we will repeat the entries. Rent account debit to prepaid rent account. Rent account debit to prepaid rent account 10,000. So here explanation is given. Treatment of prepaid expenses in the financial statement. So income statement extract from the respective expenses account. Extract from the respective, we are paying whatever the advance payment is there. So advance payment we will receive the advance expenses, and that advance expenses will be shown in the current assets. Journal entry for prepaid insurance. Journal entry for the prepaid insurance. So prepaid insurance account debit, when we make the payment, we will do the entry prepaid insurance account debit to bank. Prepaid insurance account debit to bank. Bank account credit. And when actually the expenses incurred, we will do the account debit to prepaid insurance. Insurance premium account debit to insurance premium account debit to prepaid insurance credit. Salary account debit, wages account debit to prepaid salary account debit to salary account. Simply related to the next year, prepaid salary account debit to salary account. Prepaid wages account debit to wages account. Advance expenses. Journal entry for prepaid rent account debit to bank. Prepaid rent account debit to bank. Journal entry for profit on sale of fixed assets. Profit on sale of fixed assets. Bank account debit. Cash or bank account debit. Cash or bank account debit to fixed assets to profit on sale of fixed assets. Cash account debit. Here, if we are maintaining the accumulated depreciation, we can charge the depreciation also. Accumulated depreciation. Cash account debit, accumulated depreciation account debit to assets account to profit on sale of assets account. Next is, what is the journal entry for loss on sale of fixed assets? Journal entry for loss on fixed assets is cash and bank account debit, loss account debit to fixed assets. Loss on fixed assets. Cash account debit, loss on sale of fixed assets account debit to loss on sale of assets account debit to fixed assets. So explanation, cash is a real account, debit what comes in, loss of sale is a nominal account, debit or loss, assets is a real account, credit what goes out. So the next journal entry for goods given is a charity or free sample. So whatever the goods or distributed the free sample is the advertisement, and we are giving the goods, so it will reduce our purchase account. So the journal entry will be charity account debit or advertisement account debit, purchase account credit. Example, charity account 20,000 and purchase account 20,000. Next question is, okay, advertisement account 50,000. Company Unreal Private Limited distributed goods for free sample, which cost 15,000 to the company. Journal entry for the goods distributed as free sample will be posted as advertisement expenses account debit to purchase account credit. Treatment of free sample in the financial statement, the amount is reduced from the purchase in the trading account. It is shown as an expenses on the debit side of the profit and loss account. What is the journal entry for what is the journal entry for cash discount? Journal entry for cash discount at the time of sale. We give the cash discount at the time of sale. Assuming the buyer avails the cash discount in the above examples, we have provided an example of journal entry for cash allowed and cash received, discount allowed and discount received. So the journal entry is journal entry for cash discount allowed. Cash account debit 29,700. It is a real account debit. What comes in? Discount allowed 300 rupees nominal account debit all expenses. Debtor account, debtor account, personal account, credit the giver. Example 2, example for journal entry for cash discount received. So cash discount we are receiving in the purchase and discount we are giving at the sale. So the entry will be creditor account debit, accounts payable account debit. We can say accounts payable account debit to cash to discount received. What are closing entries? What are closing entries? At the end of the accounting period, when the books of accounts are at finalization stage, some special journal entries are required to be posted. In accounting terms, these journal entries are termed as closing entries. The main purpose of these closing entries is to bring the temporary journal account balances to zero for the next accounting period, which keeps the accounts reconciled. As similar to all other journal entries, closing entries are posted in the general ledger. Once all the closing entries have been passed, only the permanent balance sheet and income statement account will have balances that are zero. Most common example of these closing entries can be seen in the temporary account like the revenue account, dividend account, expenses account, wages, office expenses, electricity. These accounts are to be zero and their balances should be transferred to permanent account. Permanent account in which balances are transferred depend upon the nature of business of entry. For example, in case of company permanent account are retained earnings account, and in the case of firm or a sole proprietorship accounts, capital account absorbs the balances of temporary accounts. Closing entry for revenue account debit to income summary, being all the revenue transferred to the income summary account at the end of accounting period. This is nothing but the income summary is nothing but the profit and loss account. Income summary is nothing but the profit and loss account. revenue revenue account debit to profit and loss account. So revenue means the sale transfer to profit. Sales transfer to profit. Closing entry for the expense account. Expense expense for the business, it will reduce the profit. So income income account, income summary, profit and loss account debit, normal balance of the profit and loss account is credit. So when we make it debit, reduce the balance of the it will reduce the balance of the profit. So we will debit the profit and loss account and credit the expense account. Closing entry for profit and loss account in income summary. Profit and loss account. Closing entry for profit and loss account or profit and loss. This is our profit and loss or income summary. So how we will the profit and loss balance will be transferred to the profit and loss appropriation account. Profit and loss appropriation account. So here the profit and loss account generally have a credit balance. So we make it debit to transfer the balance. Debit profit and loss account, credit retained earning account. Some example is given. Let's say if business generate the revenue of 1,000 in a particular accounting period and incur the expenses worth rupees 950, the amount transferred in the retained earning would be 1,000 minus 950 is equal to 50 rupees. In case if expenses are more than the revenue the business comfort losses, then the above mentioned journal entry will be reversed. We are going through as per business making the profit. If it is a loss, then the interest will be reversed. Closing entry for dividend capital reduction. Dividend is the expenses for the business. Dividend is the expenses for the business. So the retained earning balance will increase. So to increase the balance, we will debit the retained earning accounts. Retained earning is nothing but the profit and loss appropriation account. So we will debit the profit and loss appropriation account and credit the dividend account. What are rectification of entries? Rectification of entries. When an error is committed in the books of account, the same should be corrected to show the true figure in the financial statement. If the error is immediately identified, it may be fixed by striking out the wrong entry and replacing it with the correct one. However, if the error is identified at the later stage, the correction should be made by passing a suitable journal entry. Such entries used to fix an accounting error are called the rectification entries. Nowadays, a software package, if a journal entry has been posted to the ledger, it usually requires rectification entries. However, if it is still at a preliminary stage of the validation, then it may be corrected without need of additional entry. Errors are required to be rectified before finalization of books of account. Stated below are types of error and their respective rectification entries illustrated with example. Rectification entry for error of omission. Omission made for the purchase of omission made for the purchase of machinery worth rupees 50,000. The same can be rectified by passing the simple double entry that can record debit and credit aspect of this business. means the following entry shall be posted. Machinery account debit to cash account. Purchase of machinery. Rectification of the missing entry for the purchase of machinery. The above rectification cash can be posted in the cash book and cash account. Office equipment can be entered in the office equipment ledger account, which means the error has now been rectified. Rectification entry for error of commission. Error of commission or error of omission means completely forget. Error of commission means wrong wrong figure entered. Suppose purchase goods of 10,000 rupees, purchase goods of 10,000 from Z but recorded in the B account or Y account. So the correct entry the correct entry was purchase account debit to Z account credit, but we recorded purchase account debit to Mr. B account. So here purchase is correct. Only the Mr. Z replaced with B. So the rectification will be Mr. B account Mr. B account debit to Mr. Z account. We have already Z account we need to credit, so we keep this ledger the same. We credited the B, so we reverse the B. So this was the error of commission. Now see the error of principal. What is the error of principal? Suppose assets should not be recorded as a assets of sale of assets or purchase of assets should not be your income and should not be recorded in income and expense account. Sale of building 10 lakh rupees entered into the sales account. So sale of building recorded in the sales account. It should be recorded on the assets account. We will see the examples. Bank account debit, correct entry is bank account debit to building account. But we recorded bank account debit to sale account. So here bank is correct in its place. Instead of sale, we should record the building account or assets account. So we will debit the sale account and credit the building account. Rectification entry for compensation. So compensation is nothing but the overwritten or underwritten. So we have this is the fourth type of rectification entries. Earlier we have seen omission, commission, written in other name, principal, different account we recorded, and this is the compensation. Rent income is overstated by 10,000. So rent is an expense and expense more recorded more. The salary expenses is over recorded 10,000. Salary is an expense, so expense recorded more in the books of accounts. So this will reduce the profit. Since the rent has a credit balance and salary expenses has a debit balance, okay, rent income, rent is income also, sometimes expense also. If we are paying expense, if we are receiving income, income rent income balance will offset the overstatement of salary account. There will not be any effect on trial balance. Rectification of the same shall be done by reducing the rent income and expenses, salary expenses. So the entry is rent receive account debit to salary paid account credit. Okay, next journal entry is, what is journal entry for? Recovery of bad debts. So first we need to understand what is bad debt. Bad debt is means, suppose we sell the goods of 1,000 rupees to A, but A could paid only 900 rupees. So the 100 rupees becomes our bad debt. So the journal entry for the bad debt is, and that 900 rupees, it was journal entry for bad debt or what? Journal entry for recovery of bad debt. Okay, bad debt recovered. So the 100 rupees which was bad debt, now that amount we are receiving. So the journal entry will become cash or bank account debit to bad debt recovered account. Cash or bank account debit to bad debt recovered account. Bad debt recovered. Now that bad debt recovered amount will transfer to the profit and loss account. So it will increase the profit. So we will credit the profit, debit the bad debt recovered. So this is the explanation. Bad debt is shown in the credit side of profit and loss account. Bad debt is shown in the profit and loss side of credit balance. Journal entry for recovery of bad debt. So this is another example of bad debt. Cash account debit to bad debt recovered. This is bad. Next entry is, what is true up entry? It is the most generic form. True up means to match, reconcile, and tie two or more balances. So in accounting, this adjustment entry is called true up accounting. True up accounting is match with the invoices. Entry match with the invoices. We will see the examples. So this affect in the budgeting, timing differences, error and omission, and quantification. True up entry, time difference. Let's see the example. Unreal Private Limited received their electricity bill for first quarter, second quarter. The account pre-booked the accrual for 10,000 as an anticipated expenses in quarter one. However, in quarter two, when the actual bill was received, it was 12,000. So true up entry was booked to raise the expenses by 2,000. I hope you have understood. So suppose we predict the expenses 10,000, but when the bill comes, it was 12,000. So whatever the difference will come, less expenses will book. So this is called the true up entry to match the expenses. So in first quarter, we book the entry electricity account debit to outstanding electricity 10,000 rupees debit and 10,000 rupees credit. So in the next quarter, we will book, when we make the payment, we will do the electricity account debit 2,000 rupees, outstanding electricity account debit 2,000 to bank account in the second quarter, 12,000. Example 2. One example is, I think, enough. You can take the screenshot and you can learn yourself. Take the screenshot for the true of accounting entry. What is the reclass entry? Okay, reclass entry. Accounting for the business also means being responsible for adjusting and correction. One such, one such adjustment entry is reclass. Reclassification of journal entry. The process of transferring an amount from one ledger to another ledger is termed as reclass entry. Suppose you make a sale, but you record it in the purchase account. So from income to expense account, you are moving the balances that is called reclass entry. Most often, for correction of mistake, use of the reclass entry for correction of mistake, reclassification of long-term assets, for reclassification of long-term liabilities, for changes. Example of reclass entries. Though there are quite a few reasons to perform reclass entry, however, we will illustrate one of the most common scenario correction of mistake. The balance, the finance department book expenses, rent for the current month using the below journal entry. Bank account debit, rent account debit to bank account. The above entry was posted to rent account in error as the original payment related to the telephone expenses. Actually, expenses were telephone, but wrongly we book as a rent. So this is also one type of the rectification of entry. So the correction reclass entry is telephone expenses account debit to rent account. Rent we credited, earlier we debited, so here we are crediting the rent and we are debiting the correct, we are debiting the correct account, correct expenses. Okay, reclass entries. Credit card sales. Okay, this was the telephone expenses account debit to rent. Next is accounting for accounting and journal entry for credit card sales. So we know the credit card is basically for the work on commission basis. So the commission account will be added or will come to the picture while making the entries. Digitalization and modernization have made the credit card a very common mode of payment. Credit card allows customer to stop without cash and make the swift hassle-free payment. Quite frequently, credit card payment means business have to deal with the aspect of accounting and posting journal entry for credit card sale. There are majorly four credit card issue in the world: Visa, Master, Discover, American Express. For accounting and journal entry for credit card sales, there are two scenarios. One scenario when cash is received at later. Second scenario when cash is received immediately. Accounting for credit card sale when money is received at later date. In case of the company bank account is not linked to the payer bank, then the business receives cash at a later date. The seller need to submit all the receipt of credit card sales as prescribed by the payer bank. Money is credited to the company's account after deducting the commission on credit card sale. Journal entries when the amount is due. When the amount is due, it is shown as accounts receivable in the book of account. When the journal entry when dues are settled at later date. Following journal entry is posted in the ledger account when the amount is settled and the company account is credited with the net amount after adjusting commission. So the journal entry bank account debit, commission account debit to accounts receivable account. Bank account debit, commission account debit to account receivable to book the expenses. For example, Unreal Corporation has 5 lakhs as credit card sale on 10th January, which is due to the settled on 30 of the January. Commission rate charged by the issuer bank is 2% on total sales. So the journal entry is account receivable account debit to sale 5 lakh rupees. Account receivable account debit to sale 5 lakh rupees. Account receivable account debit 5 lakhs to sale credit 5 lakh rupees. Account receivable account is used to show the amount due. Journal entry on the date of settlement. Journal entry on the date of settlement. Bank account debit. Bank account debit 4,90,000. Commission account debit 2% of 5 lakhs 10,000. Credit account receivable account. Credit account receivable account 5 lakhs rupees credit. Accounting for credit card sale when money is received immediately. Bank account debit, commission account debit to sale. Examples: bank account debit, commission account debit to sale 5 lakhs rupees. What is the journal entry for interest on capital? What is the journal entry for interest on capital? Accounting for journal entry on interest on capital. Owner may seek a return on the investment in the form of fixed assets. Okay, we will just go for the journal entry. Interest on capital account debit to capital account. Interest on capital account debit to capital account. Next example is the given interest on capital account debit to capital account. Next journal entry. What is the journal entry for interest on drawing? So interest on drawing, we already know what is the drawing when owner is taking back the money or goods from the business, that is called the drawing. And if the interest is charged, what will be the journal entry? So the journal entry on interest on drawing account debit to interest on drawing account. Drawing account debit, drawing is the expenses and interest Interest is the credit. Increase in income. Increase in income. Interest is the income. Increase in expense. Increase in income. Examples, you can take a screenshot because video is too long. Video go too long if I explain to interest and capital. Next question is accounting and journal entry for provident fund. So we will just see the journal entry for the provident fund. We will not go for the explanation. You can take the screenshot. You will understand very simply and simple explanation is given. Salary account debit, salary account debit to bank account to provident fund account. Salary paid for employer on contribution. Salary account debit to employer contribution account credit when both amount is deposited. Provident fund account debit, company contribution account debit to bank. This is deposited into the government account. Example of accounting for provident fund. So this is the example and scenario. Same journal entry, salary account debit, bank account credit, provident fund account credit. Then salary account debit to company contribution to PF account credit. When this contribution is deposited to the government, provident fund account debit, company PF account debit, company contribution account debit to bank account credit. Okay, what is the journal entry for bill of exchange? So we know instead of paying the cash, we will give the agreement paper that is called the bill of exchange. So we will see the journal entry for bill of exchange in the book of drawer. Customer account debit to sale account normal entry, but in the bill of exchange, bill receivable account debit to customer account. Bill receivable account debit to customer account. We sell the goods to the customer. We will receive the bill. When actually we receive the money, credit sale account, bank account debit to bill receivable account credit. Bank account debit to bill receivable account credit. On purchase at the time of purchase, bill of exchange at the time of purchase. So generally we will record the entry purchase account debit to supplier account. So supplier will give the bill of exchange. So we will record the entry supplier account debit to bills payable account. Supplier account debit to bills payable account. So when we receive the money, bills payable account debit, bills payable account debit to credit the bank account. What is the journal entry for credit sales and cash sales? So the journal entry for the credit sales is account receivable account debit to sale, and the journal entry for cash sales is cash account debit to sale. You can see the explanation, you can pause the video, you can see the explanation. Debtors account debit to sale. Golden rule of accounting applied UK style. So the golden rule of accounting according to the UK style is nothing but the pure personal account, real account and nominal account rule. That is called the UK style golden rule of accounting. And what is the rule of accounting applied US style? US style of accounting rules is nothing but the increase or decrease of the assets or liability or income of expense. Journal entry, credit sales journal entry, account receivable account debit or person account debit to sale. Accounting entry for cash sales, cash account debit to sales. Explanation is not required. If you want, you can pause the video, take the screenshot, and take the explanation. Example for entry for cash sales entry, cash account debit to sale. Journal entry for journal entry for credit purchase and cash purchase. So the purchase entry will be purchase account debit to accounts payable account or to sundry creditor account or to name of the company, name of the vendor. Journal entry for cash purchase, purchase account debit to cash account credit, purchase account debit to creditor account or we can say accounts payable account. So golden rule applied as per UK style, golden rule applied for the modern rule as per the US style. US style applies the rule in case in the sense of increase or decrease of assets and liabilities, increase or decrease of income and expense. Purchase account debit to real account, purchase account debit to cash account. Okay, we will see the next journal entry. Journal entry for manager commission. Manager commission is considered as expenses for the business. So manager commission account debit to outstanding manager commission when the manager commission is due. Manager commission account debit to outstanding manager commission. Outstanding manager commission account debit to bank when paid the manager commission. And when transfer the manager commission, profit and loss account will be debit to manager commission account. Features of manager commission, calculation of manager commission. You can take the screenshot manager commission divided by 100 into net profit or manager commission divided by 100 manager commission. Second, second scenario, manager commission divided by 100 plus manager commission into net profit. Can take the screenshot, pause the video and you can read the description. There is so simple description and explanation. Journal entry for income tax. Journal entry in case of the sole proprietor. Income tax account debit to bank. Drawing account debit to income tax account. Journal entry in case of partnership form. Profit and loss account debit to income tax account. Profit and loss account. So income tax will reduce the profit. So profit and loss account debit to income tax account credit. Accounting and journal entry for closing stock. Accounting and journal entry for closing stock. So what is the journal entry for closing stock? Closing stock is an assets. So closing stock account debit to trading account credit. So closing stock will come in the trading account credit side and closing stock comes in the balance sheet asset side. Balance sheet asset side. When the closing stock is shown inside the trial balance, uncommonly but possible scenario where the closing stock is shown in the trial balance, it is only possible when the closing stock is already adjusted against the purchase. Below is the journal entry for closing stock when it is reduced from the purchase. So don't skip the video. You need to pause the video and you need to watch the videos. Closing stock account debit to purchase. In this case, it will be shown in the balance sheet, not in the trading account, because it is already adjusted with the purchase. Balance sheet, closing stock. What is the journal entry for carriage inward? Carriage inward means transportation in the purchase, transportation at the time of purchase. Purchase account debit, carriage inward account debit to bank account. Trading account debit to carriage inward. This is transferred to the trading account. Carriage inward at the time of purchase, it is shown in the trading account. What is the journal entry? Purchasing of fixed assets. Fixed assets account debit to bank. Journal entry fixed assets account debit to bank. If it is credit, fixed assets account debit to accounts payable account. It is shown in the balance sheet. What is the journal entry for carriage outward? Okay, so the journal entry for the carriage outward. Carriage outward is the time of sale. So bank account debit carriage outward is the expenses. It come in the profit and loss account. Out uh, carriage outward accounts debit to bank account. Profit and loss account debit to carriage outward account. Transfer to the profit and loss. Example, you can see the example. Carriage outward account debit to bank. Purchase account debit to carriage outward. Carriage outward in the financial statement. So in the financial statement, it will be shown in the income statement debit side. Next is what is the journal entry for the loan taken from the bank. So the loan taken from the bank journal entry is bank account debit to bank loan payable account. Credit. Bank account debit to bank loan payable account. Example loan received from the bank account. Bank account debit to loan account. Impact of accounting equation, you can see assets came into the bank 1 lakh, liability created 1 lakh rupees. Assets and liability. So the next loan in the financial statement shown in the balance sheet. Accounting and journal entry for the loan payment. So when we pay the loan, we will pay with the interest. Suppose there is no interest, okay, so we can directly pay to the loan account debit, loan payable account debit to the bank, but it must have the interest also all the time. Loan account debit, interest on loan account debit to bank account. Traditional rule applied. Example of the loan account taken and payment with the interest. Example 2 loan account taken and payment with the interest. Impact of accounting equation on payment of loan account. So what is the journal entry for bad debt? Bad debt and bad debt. Journal entry for bad debt. What is journal entry for bad debt? What is bad? What is journal entry for bad debt? Journal entry for bad debt. Bad debt. When your customer is not able to pay the due amount part of the amount, that amount is called, partial amount is called the bad debt. So the journal entry for the bad debt is bad debt account debit to debtors account or account receivable account. Bad debt accounts then transfer to the profit and loss account. We will reduce the profit. So profit and loss account debit to bad debt account credit. Expenses explanation event debit and credit rule applied. So bad debt it is shown in the income statement or profit and loss account debit side. Journal entry for the purchase return. Purchase return is nothing but returning the goods to the seller and getting the money. So accounts creditor account debit to purchase return account credit. Purchase is debit, so opposite of the purchase is purchase return. Creditor account will debit. Creditor account normally will credit, but here we are debiting to reduce the accounts payable. Accounts payable account debit to purchase return. Explanation creditor account treatment of purchase return in the financial statement. So we will purchase return, we will minus from the purchase account. Journal entry for purchase return. Example of journal entry. We purchase and return for 5,000 goods. Explanation of the purchase return entry. Next is accounting for sales return. Accounting for sales return. What is sales return? We sell the goods to the customer, then customer return the goods to us. That is the sales return. So normally the sales is credit. So at the time of sales return, we will make it debit. Sales return account debit, and whatever the account receivable is there, we need to credit the account receivable or debtor account. Sales return account debit to debtor accounts. Explanation treatment. So sales return is minus from the sales account. Minus from the sales return. Examples of sales return. We sell the goods to 10,000 and 2,000 rupees is getting sales return. Sales return account debit to account receivable account. Explanation. Net is accounting for journal entry for advance payment, advance received from the customer. Advance received from the customer. So this is the liability for the customer until it earned. So the entry will be bank account debit to customer advance account credit. Bank account debit to customer advance account credit. When we earn, so debit the customer advance account and credit the income account. Accounting treatment for customer advance. Cash account debit to customer advance account credit. Step 2 account receivable account debit to revenue account. So this is nothing but the advance account. Advance customer advance account debit. We earlier we credit and now credit the income account. Next example of customer advance. You can see the advance. Video will go long, so I am just skipping the explanation. Accounting journal entry for rent paid. Accounting and journal entry for rent paid. Rent paid journal entry will be rent expenses account debit to bank account. A rent expenses account debit to bank or cash account. Rent expenses account debit to bank account. rent expenses account debit to bank account. Treatment: rent expenses account debit to bank account. Then transfer to the when we transfer to the financial statement, expenses account debit to rent account. Income and expense account debit to rent expenses. In financial statement, office rent is shown in the income statement of income statement. Example of rent paid. Example 2 of rent paid. Journal entry for paid by check. Rent expenses account debit to bank account. Then expenses, income, profit and loss debit to rent expenses. Profit and loss account debit to rent expenses. Example of rent paid through the bank expenses. Journal entry for rent paid in advance. Rent paid in advance. Prepaid rent account debit to bank account. Prepaid rent account debit to bank account at the time of payment. Then first month end, when you use the service, we will record rent expenses account debit to bank account and 1 month rent, full amount, 1 month rent. Prepaid rent account debit to cash. Explanation. Journal entry for rent received. Journal entry for rent received. Bank account debit to rent receive account. 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 So bank account debit to rent receive account credit. Transferring the receipt to the profit and loss account. So profit and loss account will be credited and debited will be the rent account. Rent receipt, it will come in the credit side of the balance sheet. Example of rent receipt, bank account debit, rent receipt, journal entry for rent received in advance. Example of rent received of rent receipt, journal entry. Second examples, journal entry for rent received with TDS and GST. Journal entry, rent received. Bank account debit, TDS account debit, TDS receivable account debit to rent account to GST liability account. Bank account debit, TDS assets account debit, rent account credit, and GST liability account credit. GST is charged as a liability, TDS is treated as a assets. Example, bank account debit, TDS sales account debit to rent account to GST payable. Accounting for journal entry of salary paid. Salary account debit to bank account. 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 Salary payment of salary. Salary account debit to bank account. Transfer the salary to the profit and loss account means profit and loss account debit to salary account. Profit and loss account debit to salary account. So here salary will come in the profit and loss account. Bank account will come into the balance sheet. Example of salary payment. So journal entry for salary paid in advance. So at the time of advance salary payment, we will record debit, prepaid salary account debit to bank account, prepaid salary account debit to salary account. So this is the bank account when we pay the advance salary, and actually this is the adjustment entry, prepaid salary account debit to salary account. Suppose the salary is 30,000 and we are paying the 10,000. So the prepaid salary will be 10,000 and salary account will be credited with 10,000. So at the time of making the payment, salary account we will pay the balance amount, like 20,000 is the balance amount on 31st March. On, on 31st March, ABC company paid salary amount 45,000, 15,000 into 3 for the month of March, April and May to one of its employees. So the journal entry will be posted in the books of account. So salary account debit to bank account. This is the normal entry. Salary account debit to bank account. Suppose if we are prepaid salary, we are making the 3 month salary together. Salary account debit to bank account. So March 31st March, the first month salary will be 2 months salary. Prepaid salary account debit 30,000 to salary account credit. On 1st April, the salary account will be salary account debit to prepaid salary 15,000. Journal entry for salary to partner. So the partner salary account debit to partner's capital account credit, and you can see the explanation. Partner capital account to be credited if capitals are fluctuating. Partners account to be credited if capitals are fixed in the nature. Step 2, transfer to the profit and loss appropriation account. So profit and loss appropriation account debit to partner's salary. Journal entry examples of partner: end of the month, date of the payment. Journal entry for director remuneration. Director remuneration is the expenses for the business. So what is the director remuneration? You can read the explanation. The entry will be director remuneration account debit to cash account, and when it transfer to the profit and loss account will reduce director remuneration. It comes in the profit and loss account. Example of director remuneration to bank, profit and loss account debit to director remuneration account credit. So that is the end of this record to report journal entries. I hope you have understood about the journal entries and questions and answer of a record to report, interview questions and journal entries. If you have any doubts, please comment on the videos and follow our channel. Thank you for watching.